So let's start talking about investing and the fundamentals of investing. We've already done savings, talked about how to save and choosing to save and how time and interest rate and all those things work together, the amount of money, but now let's talk about investments. So what are investments? You can put this in your note-taking guide if you'd like. Investments are assets purchased with the goal of providing additional income from the asset itself, but with the risk of loss. Many people are scared of investments. They think, I'm not going to invest, I can lose my money. Yes, there is a risk of loss. There's no denying that. But hopefully this presentation will educate you a little bit more on some of the benefits of investing. So by having a financial plan, saving, and investments all wrapped up together, you can put yourself in a very secure financial position. All investments have some risk. So return is the profit or income generated by saving and investing. And the trade-off, higher returns equal a higher risk, and which is a chance of loss. So with investments, you can make much more than you can make putting your money in a savings account, but there's a possibility that the investment will fail to pay the expected return. So there is a risk involved. Is it a big risk? It depends on what you are investing in. Some are smaller than others, and we will talk about lots of different types of investments and their risks. Investments do have a potential for higher returns. You can make lots of money. You can make higher interest rates, higher returns in investments than you can in other tools. Investments are important to building net worth. Your savings tools are your monetary assets, and those are liquid, quickly and easily converted to cash. Your investment tools are farther down in your statement of financial position. They may not be easily converted to cash, or penalties are charged if you access the funds early. So they are meant to stay invested and not to just be used on a daily basis. Investments are less liquid than savings tools. Investments help accomplish long-term goals. Money invested is usually used to pay for long-term goals, such as buying a house, higher education, retirement, and it is recommended that at least 10% of net income is dedicated to saving and investments each time income is received. So that whole 10% doesn't have to go in savings. It can be used in investing as well. So we are now comparing saving and investing. Saving is used for emergencies, where investing is more for long-term goals. Savings is more liquid, where investing is less. Saving is limited risk, where investing is higher risk. Saving is lower returns, usually 0 to 4%. Investing is higher returns, can be around 8 to 12%. And saving is more for financial security, where investing is more for building net worth. So that's a really good chart comparing how those two are different. So rate of return. Rate of return is the total return on investment expressed as a percentage of the amount of money saved. The total return divided by the amount of money invested is your rate of return. So what is Mandy's rate of return? Here's an example. She saved $2,200 in a money market deposit account. After 1 year, she has a return of $110. So what is her rate of return? You take 110 divided by 2,200, and it gives you 0.05, which is a 5% rate of return. Inflation is the rise in the general level of prices. Probably know that. But inflation risk is the danger that money won't be worth as much in the future as it is today. So how does that relate to investing? We want to have a rate of return that's higher than the rate of inflation, so that with prices going up, we've made enough money to be able to buy the same things we could buy before. So we want to keep up with that rate of inflation. So type of investment tools. In this presentation, we'll get into each of these individually: bonds, stocks, real estate, speculative investments, mutual funds, and index funds. Think about what you already know about those. I'm sure you've heard of stock before. Do you know what it is? Do you know what mutual funds are? How about bonds, real estate, index funds? We'll talk about each of these in detail. So let's start with bonds. Bonds are a form of lending to a company or the government. They are an organization pays interest to the lender, which is the purchaser, until the maturity date is reached. The maturity date is the specified time in the future when the principal amount of the bond is repaid to the bondholder when it reaches that date. It is the least amount of investment risk when we're talking about our investing options, depending on the type of bond. And it has a fixed interest rate, so you know what the interest rate will be when you choose a bond. Now stocks. Stocks are a share of ownership in a company. The stockholder or shareholder is the owner of the stock. Usually a stockholder owns a very small part of the company. Stocks provide dividends. Dividends are a share of profits distributed in cash to stockholders. And you may or may not receive dividends depending on if the company issues them. Usually a company will issue them at the end of the year, but it depends. And then that is just pure profit to you if you own that stock. Capital gains is the market price, first of all, is the current price you're willing to pay. And if you sell it for higher than what you pay for it, you've earned unearned income, which is capital gains. And that's from the sale of an asset above its purchase price. If you sell the stock for lower than what you paid for it, you will lose money. So there's no capital gains because you're selling it for less. You've lost money. Real estate is ownership of residential or commercial property or land. And there is a potential for returns. Capital gains is selling the property for more than what you bought it for. And then you can charge other people rent as well for using the property, and then that's money you can earn as well. So definitely money to be made in real estate. You might know someone who owns properties that they rent or land for an investment purpose. So it can be time consuming, but there is a high potential for returns. Speculative investments may be new. These are high risk investments. They have the potential for significant fluctuations in return over a short period of time, meaning they can go up and down in value. Futures, options, and collectibles are some examples of these. And the type of return depends on the investment. So collectibles might be baseball cards, Beanie Babies, something you've collected and then you hope to sell for lots of money. Think Pawn Stars or a show like that where people bring their items in to see how much they're worth. Sometimes they're worth a lot and sometimes they're not. So it really depends on the investment because it can be risky. Mutual funds are when a company combines the funds of many different investors and then invests that money in a diversified portfolio of stocks and bonds. What is included? Bonds, stocks, real estate, speculative investments are all included in a mutual fund. So it's kind of a big smesh gathering of everything, trying to think of a good word for it. But so you can earn interest, dividends, rents, and capital gains. But it's a combination of all of these things. An advantage of mutual funds is it saves people time not having to choose what stocks and bonds you want. It reduces risk because there's lots of different ones involved in the mutual fund. Disadvantages, you could be charged fees for that mutual fund because someone is managing that. So here's an example. Ariana has $150 to invest, and option 1 is stock. So she invests in one company stock, which would be letter C here, and they have a bad year and the price drops. She may lose her whole $150. She won't lose more than that, but she can lose her investment. Now, if she option 2, if she chose to invest in a mutual fund, you can see her money is in A, B, C, D, E, F, and G, so 7 different ones. And C still went down, but so did F, but the other ones all increased. Then she's reduced her risk, and she can still earn money. An index fund, then, the last type of investment we'll talk about now, is a type of mutual fund designed to reduce fees by investing in the stocks and bonds that make up the index. An index is a group of similar stocks and bonds. An example is the S&P 500, Standard & Poor's 500. So your fund will mirror how the index is doing, and that way if it's generally going up, it will go up. It's a little bit less risky than some other mutual funds. When investing, consumers are either lending money to a company or they're owning it. And so examples of lending are bonds, and then you can make interest on bonds. And owning would be stocks, real estate, speculative investments, and then those you can see dividends, earning from rent, and capital gains. So a good comparison of lending versus owning and how that is different. And the knowledge of the general risk level helps manage your risk. So interest is lending, owning is dividends, rents, and capital gains. Decreased inflation risk here, and increased potential for returns here, increased investment risk over here. Bonds, mutual funds, and index funds can all be part of the interest one. And then stocks, mutual funds, real estate, index funds are all part of the owning section. All right, so now ordering cards from lowest to highest of investment risk. Bonds is the least risky, mutual funds, index funds, stock and real estate, and speculative. That's kind of the order from least risky to most risky for investment. So in class, you would have had these cards and you would have had to lay them out and say which one is the most risky all the way to the least risky. So speculative is the most risky, then individual stocks and real estate, mutual funds and index funds, and bonds are the least risky. Now if you had to order them from potential returns from lowest to highest, bonds are going to make the least amount of money, then mutual funds and index funds, stock and real estate, and speculative. And you'll notice that's exact same as before because risk and return are related. If it's less risky, less amount of returns you'll be usually making. And then if it's very risky, you can make a lot, but you can also lose a lot because risk and return are directly related.